Welcome. Good afternoon. You're watching us here on Halftime Report. I'm Manglam Malu. With me, Sonia Shenoy as well as Ekta Batra. Not looking as bad as it was, an hour ago for the markets. The Nifty is down 100 points. Yes, the Sensex down about 400 points as well. But the recovery from the lows has been pronounced. And at the same time, the Nifty Bank, which was down at 200, 250 odd points at one point in time, is now down just about 65 odd points. And the mid-cap index is doing much better. Almost 1% gains on that index. More stocks advancing than declining. And while we will talk about individual stocks, just keep in mind we got numbers from Varun Beverages moments ago. A strong 27% jump in their revenue comes off a low base, and we've seen the profits of the company as well jump all the way up from 16, 17 odd crores to about 64 crores, and as a result of which that stock's surging away up 6.5% as we speak. So good going for individual pockets. But some weakness in the front line end.
Oh, absolutely. Some weakness. And a lot of the Adani Group stocks are also off from their lows, right? So that is a good thing, that at least the kind of volatility that we saw last week in Adani Group stocks, there is a little bit of settling of that. Some of them are, in fact, in the green. Ambuja Cements in the green, Adani Enterprises as well. Yes, there's a lot of to and fro in terms of, data points. But for now, Adani Ports is up about 4.5%. For now, some semblance of sanity is what we're seeing in terms of the Adani Group stocks. A lot of big numbers coming through this week. The Tata Steel today. Through the course of the week, you have the likes of M&M and a couple of others as well. So we'll track all of that very closely. But for now, we have some managements joining us.
Yes, Sonia, Manglam. Well, it's turning out to be a session where we are seeing some amount of resilience for the broader markets. And courtesy, that is a lot of stocks which are reacting positively to their numbers and have shown a good showing. Case in point would be something like a Paytm as well as Interglobe Aviation. And the other stock that we're tracking this morning is, in fact, pharmacy major MedPlus, which has posted what was a good set of numbers. Revenue is up around 27%. However, the profit is lower due to a high base. This is on a year-on-year basis. Mr. Reddy, who's the MD and CEO of MedPlus Health Services, joins in on the show to discuss business with us. Mr. Reddy, hi. Thank you very much for joining in. Well, it has been a strong showing, but I just wanted to understand how much of this was on a like-to-like basis. The reason I ask is that you all have been quite aggressive on your store addition. So how much of this was actually because of organic growth, and how much of this over 25% growth was because of new stores being added in the past 6 to 8 months?
See, I don't have the exact breakup for you right now, but I can tell you this, that our old stores continue to perform. We continue to increase our gross margin. We also continue to increase our private label. So they continue to be profitable. We will come out of the full numbers, shortly and all on the analyst call. But the part of the growth is definitely due to the new stores which we are coming in, but our old stores continue to do well.
Okay. Mr. Reddy, just one more follow-up with regards to the pharmacy business. The big question is, how much were you discounting this quarter? Because you all have said that your average discounts have been on a consolidated basis at around 16.5%. This is despite omni-channel delivery and expansion of PIN codes. But this is versus the online players, which are at around 20, 25%, say, for the first 3 transactions, and then they sort of get, hooked to that particular online pharmacy. So what were discounts this quarter? How is it panning out vis-a-vis the industry?
So on the omni-channel side, I'm not sure if there's anyone else other than Apollo out there. I'm not sure what their numbers are. But for us, we have been pretty steady at the 16.5% kind of discount. And that is because, we have a hurdle-based discount. All bills above 1,000 have a 20% discount, and that is the larger part of our business. And bills below 1,000 have a 10% discount. So the blended discount, with everything included, all the FMCG, which has a slightly lower discount, which is at 5%, comes to around 16.5%, which has been pretty steady for us.
Okay. Mr. Reddy, good afternoon. I remember when we spoke in the month of December, you had said that overall you're expecting a 20% growth in your revenues for this year, and that's a trajectory you'd like to maintain next year as well. Would you change that stance at all?
I would say more mid-20s rather than just the lower 20, but that's about it. I don't think it will change much because we expect to grow our stores at the same level, and we also expect the overall growth in the company to be roughly around the same.
I wanted to understand your thoughts on a couple of things, Mr. Reddy. The first one was in the diagnostic business, the competition that there is, because we do have a lot of players eyeing for the same clutch of customers, so to say. So what are your thoughts on how the margins are likely to pan out for the industry going forward? And secondly, is on your expansion itself. Most of your expansion, as we see, has come in tier 2, tier 3 cities. Are those, centers a lot less profit making, or, does it take longer to break even there? What are the unit economics of opening stores in tier 1 versus tier 2?
Okay, all right. Let me take your second question first. The tier 2, actually, as far as profitability and break-even is concerned, is more favorable. The top line is slightly lesser by around 10% or so, but the overall EBITDA and overall, path to profitability is actually faster. So we don't suffer when we actually do more of those anyway. We also do tier 2 mainly because of one thing. Once you already have a setup, once you already have the supply chain set up in a state, then it pays to actually maximize the benefit out of it by putting in as many stores as possible into that particular territory or state. Hence the push into the tier 2 sites. Again, we also feel that tier 2 is again place where the value proposition which we have resonates equally well. In fact, even more so. One of the main reasons why we even set up the company was to make sure that everyone has access to genuine medicines. There's a lot of fake medicines across the board. And if you look at the tier 2, tier 3, there is more prevalence of fake medicine. So the value proposition which we have, making people, have access to genuine medicines at the same time, giving them at a price which no one else can beat, resonates very well in the tier 2 and tier 3 areas. So that's the logic for that. Or to the first question, is there a lot of competition? I don't believe there is competition in the area in which we are playing. We're an integrated center which has got radiology, pathology, biochemistry, and the entire works. We're not a center which just goes home and collects samples and brings it and does the lab, just the biochemistry lab. That part, you're right. There's a bunch of new entrants. There's a bunch of, e-commerce guys. There's a lot of other people who are there, but that's not where we are. In our area, we believe there's only a couple of major competitors. One is, of course, the local player, Vijaya Diagnostic, which is, fairly well entrenched in AP, Telangana and all. And then there's a couple of other guys here and there, but there's no one who's pan-India and there's no one who has significant scale.
Just a quick last question, Mr. Reddy. For your diagnostic business, it's on a pilot scale, pilot project basis right now. It includes pathology as well as radiology, which is basically MRI or CT scans, etc. Just tell us what the footfalls are this quarter as compared to the last quarter, and what are you expecting, say, in the next 2 quarters?
So we opened one more larger center this quarter. We had 2 earlier and we opened the third one. All of them, the first 2 have been breaking even for a while. The third one is also ramping up very well. See, our thing, if you remember, is a subscription-based model. And till the end of last quarter, I think we have had in excess of 60,000 memberships overall. So the membership model continues. People get, let us say, buy into the overall company's offerings through a membership. And once they are there, they become very sticky. So we are seeing that part of the thing play out for us. We have a deep discount, which is 75% discount, but that is only available to members. And almost everyone who basically takes our services becomes a member. And once they become a member, then they continue to avail of our services. So for us, then the marketing cost, the doctor referral cost, and all the other costs are almost non-existent. So the answer to your question, is it tracking to our expectation? Absolutely. They are breaking even. The goal is to actually put in 12 centers in entire AP in Hyderabad alone for the first phase of the overall thing, the pilot project.
Okay, all right. We will leave it at that. Thanks a lot for joining in and speaking to CNBC TV 18. Let's slip into a quick break on that note. On the other side, we'll bring you our exclusive discussion with Aswath Damodaran of NYU Stern School of Business. He has a view on the valuation concerns with respect to the Adani